All right, mortgage rates are dropping. Huge week. You're probably asking, Kenny, why are they dropping? What does this mean for me? How can I take advantage? But also, are they going to drop further? Are they going to hold here? And honestly, guys, unfortunately, I don't have all those answers, but what we can do is we can explain why the rates have dropped, what's kind of going. And obviously, unless you've been living under a bridge, a rock, or on an island, you know, there is lots of stuff going on out here in the market. There's lots of stuff going around here in the US, the world, everything. Obviously, a new administration coming in, shaking things up, looking for, look, what did the American people want? They wanted transparency. They wanted to cut the deficit, quit spending, all this insane stuff. So what you're doing is having a large group of people come in, shake everything up, expose a lot of obviously waste, fraud, corruption, spending on both sides. It doesn't matter. Like I keep telling you guys over and over, we can't take in 5 trillion, spend 7 trillion. I've been telling you guys on this camera for many years that the government has been propping up this economy. Yes, they have been putting money into the economy that is causing all of our stuff to stay high. And that includes interest rates. It's confusing the Fed, it confuses the bond market, it confuses us in our market, and obviously it props up. So if you wonder why you go to Disneyland, you go to Vegas, you go on trips, you go to hotels, you go on restaurants, you go all this stuff, how do people have all this money? This doesn't make sense. How have things not cracked? How have we not had a recession? How have we not had a slowdown? I can't definitely answer that question. But we can sit here and say, I know people have had jobs, but look, one of the biggest employers in the last few years have been the government. We do know that, hey, how are these people affording all this stuff? Because money does leak. If you put $1 trillion out there into the US economy, however you go, it eventually lands into people's hands and those people spend money. So I'm really convinced that all this government spending, hiring has propped up a lot of stuff, and that includes interest rates. So what you're seeing right now, people come in here and expose all this unnecessary spending that basically doesn't do diddly squat for us as Americans, but just prop things up. So if we're looking at that, that's why we're starting to see cracks and crumbles in the economy. It was starting to show anyways last year. So here's what I know, and let's dive into it because I want to tell you why rates are dropping. Could they go further, and what are the next steps and how you should be taking advantage of this? And by the way, if we've never met, my name is Kenny Simpson. Thanks for stopping by. Thanks for checking out this video. I focus on 1 to 4 unit financing. That means I help you either buy a house, buy a 1 to 4 unit property, or refinance that property. I've been doing this 20 years, funded $1 billion of loans, and I'm here to help you, educate you with these videos like this. So if you're not following me outside of this channel, maybe you're getting this email, maybe you found me on YouTube, you definitely need to go check me out on my other social channels. Obviously, leave me a comment. If I need help, if I can answer any questions, please reach out. Go check me out. Go look me up and learn a little more about me. Love to hear more about you and how I can help you solve any real estate problems, mortgage problems, or answer any general questions. We're always here to help at the Simpson team. But let's get back to why you're here. What the video is about is why interest rates are falling. Look, this is great news for anybody. We cannot sit here with interest rates this high, whether it's residential, whether it's credit cards, whether it's car loans, whether it's business loans, whether it's any damn loan, especially commercial loans. We need these interest rates to get down. We need to get them down fast because you are going to start seeing major cracks throughout the real estate market if we don't. I know people think, but you will, because sitting here is not a good thing. It's stalling out the market. You can see it you can just go online. You can hear it in the content. You can read it in the blogs. You can see it in the data, and it's just tough. So if you are in the real estate market, whether you are in the business and you work, God bless you. I know it's tough right now. Hang in there, stay positive. And if you're a buyer, you're a seller, hey, look, you got to have some patience. You got to make sure you're working with the best team. But let's jump into it to see why rates are coming down, how you can take advantage. Number one, why do rates come down? It's pretty simple, guys. It really has to do with something's happening to the market, right? So something's happening out there that is negative to what the market would do to keep rates up. Why do rates stay up? Well, unemployment could be low, the economy's booming, inflation's higher, things like that could prop rates up. Why would they stay up? Because if the economy's doing really well, that means the feds are going to talk and keep short-term interest rates higher, and they're going to signal that, hey, the market's overheated. We need to slow it down. And the way they do that is they raise rates like you saw to slow things down. Well, they jacked the rates up from, they thought 75 basis points to 500 basis points, and that slowed things down. Now you're seeing inflation come back down. You're starting to see the job market crumble a little bit. You're starting to see consumer spending slow, and overall sentiment in the market, you're starting to see people lose confidence. That could be for a number of factors, but let's just focus on they're just losing confidence. It could be a president. It could be administration. It could be a war. It could be a pandemic. It could be because they're overextended. It could be because everything's so expensive. It could be for a lot of reasons for you personally, or just in general. It's probably many of these reasons factored together. Interest rates are falling this last week because the data is not coming in very strong. And as I've told you guys many, many times, on these videos, if you watch me, if you have the first time here, you're going to realize we look at data on this channel. We really pay attention to it. And that is what we deliver to you. We just go through the data. So the data is telling us inflation reports have not spiked higher than we thought. They're coming in line. That means they're slowly cooling. And that means why you're seeing rates get better. You're also seeing consumer confidence miss. You're also seeing retail sales miss. You're also seeing the job market get a little bit shakier, right? You're also seeing, because this administration is glaring a lot of unnecessary spending, and it might start cutting and letting people go in the government. That has been, like I said, if the biggest person that is spending the most money in the economy to prop it up and hiring, and that's going to start going away, or they're going to be like, look, we cannot keep throwing $2 trillion out the window. We can't afford it. So we have to cut. We have to have a balanced budget. That is good. And just so you guys realize, one of the things, I might lose you, but I'm going to try to break this down easy. One of the things you have to realize, when we're $36 trillion in debt, and we're spending $2 trillion more, that money comes from somewhere. Some of you guys might think, I don't understand how it comes. So I'll try to explain it to you real simple. So $2 trillion has to be created in the market. People have to buy that debt. Think about it. If you're $36 trillion in debt and you have to go out there and get people to buy $2 trillion of debt to put it into our economy to keep us up, propped up, floating, whatever you want to call it. Well, somewhere outside of us have to buy the debt. And if they buy the debt, they don't want to buy that debt at a super low rate. They want to higher. So when you see treasuries and bonds go up higher, that is because that's what they require. Just like, for example, if you get a mortgage and you go out, let's say, for example, you want to sell a bottle of water. Well, if you have 1 million bottles of water and you go out to the market to sell it, and you have 100 people buying it, well, guess what? Your bottle of water might cost a penny. But if you have 100 bottles of water and 1 million people want to buy it, guess what? You're going to get more for the bottle of water. So if you have $2 trillion of debt that you need to sell, so because we need the money in the US, and you go out and there's not a lot of buyers, and to get the buyers, you've got to jack those interest rates up, right? So that's what happens is we're fighting. So the mortgage market and things like that could be buying treasuries to help mortgages. They're over here trying to buy treasuries to keep our economy up. So in English, what this means is that we need to get our deficit down. So anything this government or anybody can do to get the deficit down, I'm all for, because if we got the deficit, number one, down, if we balanced our budget, do you realize we'd have better and lower mortgage rates? So you that own real estate, want to buy a house, want to refi your house, or 7 million of you, do you realize that is a great thing? That is something we should be rooting for, because we do need to kill our spending. We need to bring it down. We need to kill the deficit. So if we can get there smartly, intelligently, wisely, and do it quickly, my goodness, at the end of that road, it's good. So once again, interest rates got better this week because the data pretty much got worse. And next week, we're coming into more and more data. When this video comes out, it will be Wednesday of this next week, and you're going to be reading this. So this week, when you're watching this video, we're going to have more jobs reports. So if the jobs report comes in weaker, rates could go lower. The next week, we're going to have more inflation. It's a monthly cycle. So if you just watch the data, if the data gets better, rates get worse. If the data gets worse, rates get better. The Fed's official, Jerome Powell, if you heard of him, that cuts rates, that's tied to your, mortgage, your HELOC, and you've seen that rate go down. They want to cut 50 basis points this year, but they're usually wrong. So in order for them to cut more, the data would have to get worse. This data could be at much, much worse. It just really depends on what happens here in the future. So how do you take advantages? Number one, if you need to refi, you should go be reaching out to either the person that gave you your loan or reach out to somebody like me. Go say, hey, this is my scenario. This is what I got. Does it make sense to refi? If not, you should understand where that number needs to be to refinance, where it makes sense for you to do the refi and save money. And that's really going to be up to you and your loan officer. Is it $200 a month? Is it $500 a month? Is it $1,000 a month? Is it half a point, whatever it is? If you're looking to buy and you're sitting on the sidelines and you're like, I couldn't afford, but rates are now 3/8, half point lower for maybe when you talk to somebody, get on the phone, get back on there, see about the pre-approval. So taking advantage of this is simple. Make sure you are in constant contact with the team you're working with, if you're refining, it would be your lender. If you're looking to buy, you have pre-approval out and you're still trying to get those rates down to have more affordability, you should be reaching out to your lender, to your agent, and having that constant communication. So now that rates are coming down, are they going to come down further? We just don't know. Like I said, nobody has a crystal ball. But if the data keeps showing up like this, I think rates will continue to drive down lower. Keep in mind that the last few years, the first quarter, the data has been much stronger overall than the continuous quarters after that. So this first quarter, if the data is not as strong, typically we've seen a decline in the data over the years. So beginning of the year has been stronger data, and data we're talking about higher inflation, better consumer spending, and also we're talking about the jobs market. We're seeing a worse jobs market this Q1. We're seeing inflation not spike, really stay in line and slowly but surely come down. And if you want to get to the nitty gritty of it, inflation data would be much lower if we actually looked at some of the current data they looked at. For example, one of the big things that the federal government, remember, when the Fed comes out and talks, he really dictates a lot of things. If he came out and said, oh my gosh, inflation is falling faster, we're going to have to cut more, your mortgage rates would be falling off a cliff, just so you know. They're not saying that. Should they be saying that? Absolutely. Let me explain why, and we're going to wrap up the video with this. If you are watching this video and you're a renter, you rent, correct? You pay rent. If you've rented your place a year ago, maybe you're locked into a lease, but you might be hearing, wow, my same unit in my building, the same house I'm renting, I'm hearing is either higher or lower now. Most of those rental properties that you're renting now that you're locked into a lease, that you're either going to renew or go move somewhere else, those rates are probably lower where you're living. So a place like San Diego, for sure, I'll talk here, our rents have come down for sure from the peak. And so what you got a year ago, you're definitely not getting today. So why I'm bringing this up is some of the biggest components or the biggest data points, let's call PCE, pricing consumer index. That inflation report is what the Feds look at that just came out. 18% of that number is dictated by rents in place. So if they know that if the rents a year ago were higher and they're lower now, you and I know if we're looking at today's data, the rents are lower, right? So that means inflation be lower. Wrong. Because the Feds actually roll in the rents from years ago. It takes a while to catch up. Let me repeat that. They use old data. They know they use old data. So they know the rent a year ago was higher than it is today. But that's the data you use because that is their model. So if they took today's rent in place, today's data, we would probably be at their target inflation report, and they would be cutting rates much more than 50 basis points, probably 100 basis points, and maybe more depending on the economy. Your interest rate on your 30-year mortgage, whatever you got quoted this week, would be probably even 100 basis points lower. Should you be upset? Absolutely. Because why? It's really, really frustrating. So people from our industry are trying to reach out, educate the administration, educate, the Federal Reserve and saying, why are you looking at old data when we should be looking at new data? So stay tuned, keep watching the data, make sure you're following people that know what the hell they're talking about, that are following the data. It's really, really frustrating. I get it because you're paying higher prices. You're paying higher everything because of this stubborn ass government, if you ask me. Because if the data was real and we're looking at it, rates would be lower. If the government didn't overhire or overspend, your eggs, your gas, your everything else, the day-to-day that costs a shit ton of money that you and I have to deal with, that is like, how is this so expensive? That's because the government propped this up with trillions and trillions of dollars that's unnecessary. So I hope we start seeing the inflation come down, the data come down, and things like that come down to where we get more of a balanced economy. We cannot have the federal government coming in here doing things to jack up or lower because it could be problematic. I understand if we have a pandemic or we have a recession or something, the government has to come in to prop things up temporarily, but we want it temporarily, folks. We do not want the government to step on the gas and bail things out over and over the years, because we will land in a bad spot like we are now, where everything's expensive, rates are expensive. And honestly, if you're a buyer, it's hard to make sense. If you're a refi, it's hard to make sense. And if you're a seller, it's hard to make sense. So hope this video helped you out. Hope this makes sense to you. If not, reach out to me. Love to jump on a call and go through your scenario with you to see if I can help you buy or refi, or we got to see, hey, where do you need to be at in the near future to buy or to refi, and what makes sense. Anyways, thanks for watching. Share this video with somebody. Also, love to hear some comments, and also you should be subscribing to my channels and following me on social. And if you found this on YouTube and you're not on my email list, look below and get on my email list. Everything's in the description. Thanks so much. Talk to you soon.